My guest today is Danny Vivier, co-founder of Evermore, a holding company building a portfolio of durable, cash-generating businesses across vertical SaaS. Evermore isn't VC, private equity, or search. It's a long-term model focused on buying overlooked businesses and helping them grow with the modern tools like AI and smart distribution. Thanks a lot for coming to the Holdco Builders podcast, Danny.
Thanks, Mick. Happy to be here.
I want to start with your story before building the Evermore. 3 years ago, you tweeted, actually 2.5 years ago, you tweeted, in less than 4 years, my wife and I sold 3.5 million worth of baby photo props online. We had no kids at the time and you worked full time. Tell me the story, because this is where it all started.
Yeah, quite the story. Well, we no longer have no children. In fact, they're kind of a dominant factor in my life right now. We have a 3-year-old and a 1-year-old. But at the time of starting what we called First Landings, it was just my wife and I. My wife was in law school. I was working full-time at a technology company, and kind of just got the bug, if you will, of wanting to attempt, a typical side hustle, is what folks would call it. And we kind of set our mind to doing something in the world of e-commerce. And so how it all started actually was I had a software tool that helped to identify the search volume of various keywords on Amazon's platform, on the Amazon marketplace. And one day while I was exploring that tool, I stumbled upon the search term newborn photography props, which was searched over 30,000 times a month in the United States. So that was, I would say, the insight. And from there, it was the typical kind of 0 to 1. Hey, let's go on. I looked at the search results page for that keyword term, noticed the product quality, the photos, everything weren't good. And this was 2018. So overall, the market of Amazon was a bit less competitive. It wasn't the early days, but still opportunity. Yeah, we stumbled onto our first product from there, sourced it internationally, went through about a 9-month R&D cycle to get it in a good place, branded it, launched it. A lot of stories there. Almost quit 3 months in when I got my first 1-star review. And I remember just thinking, oh my gosh, this isn't for me. This is so stressful. But my wife kept me in it. And 4 years later, we got an offer from an aggregator. This was in 2021. So around the time where a lot of capital was flowing into the idea of rolling up these FBA brands. And at that point, I think about the business long term. And I said, hey, this could be a good opportunity for my wife and I and our family. And so, we sold.
You did it all without quitting your day job, or for how long it all took for you to realize that, okay, it's time to go full time?
Yeah. In fact, I kept my day job for a year after the sale. And part of that was situational and the company I was working for, and my boss, who I considered a mentor, and just wanting to kind of continue through. But I think it really helped me from a standpoint of, didn't feel kind of the pressure, if you will, of needing the cash flow. We didn't really take much out of the company for the 4 years that we ran it. A lot of it was reinvested into working capital, and obviously physical goods product is different than SaaS, which we'll probably get into. Constantly building inventory, going from 0 to several million of sales a year, with a working capital cycle of 75 to 90 days. You could imagine not taking a dollar of outside capital or debt. So everything was kind of getting funneled back into it.
So there must be some time management lessons from this period of your life. Can you share any?
Yeah, and I should be transparent, right? I started my vocational career in investment banking. I hadn't started the company while I was at the bank. There was no way that was going to work. But that bridge from 80 to 100 hour a week type lifestyle to my corporate role was quite a big difference in time availability. My wife was still in law school. We didn't have children. We were in our mid-20s. We were in LA. A lot of things just allowed for me to work more than I certainly am able to these days. But we outsourced a lot of various roles. We had an amazing team of offshore staff that I would manage. And definitely a lesson in time allocation.
a quick pause. I want to talk about today's sponsor, Scalepath, which is your shortcut to the right people. Let's be honest, running a business isn't just hard, it's isolating. Whether you're raising money for your next acquisition or you're scaling through acquisitions, you quickly learn your edge isn't just your capital, it's your people and people around you. That's where Scalepath comes in. Scalepath is a private network of over 2,000 vetted operators across the US and Europe. They're not theorists, they're in the trenches, buying, building, fixing, and growing real businesses. So when you book a free call with their CEO, Rand Larson, today, he will personally introduce you to up to 3 operators who actually understand what you're doing and, more importantly, what you're going through. So go to joinscalepath.com and book a free call with Rand Larson so he could introduce you to 3 vetted operators in your area. Now, back to the show. You've shared in one of your previous interviews some of the reasons why you decided to sell, one being that 90% of your net worth was tied into all this, and obviously entrepreneurship risky, doing this business risky.
Yep.
Could you maybe elaborate a bit?
Yeah. So, and this gets into a lot of kind of what inspired the model for Evermore. But, I remember waking up one Sunday morning, and our hero listing, as they call it, our primary SKU, had been taken down by Amazon. And I remember trying to get on the phone with a human being, was very, wasn't really able to, kind of stressed out for the day. It really affects all of your, how you manage the business when your primary SKU gets taken down. Next morning, wake up and it's reinstated. They didn't say why, didn't give any kind of justification for it. And that's one of many examples where you're kind of at the will of the platform. So I just felt that very deeply. And, I had spent enough time where I felt like I'd kind of taken the business to where I felt like it, I could by myself. And, I also was fortunate to sort of see some of the macro capital accumulation around the space, right? The idea of these aggregators coming in and all competing themselves. And because of the investment banking background, I was able to run a bit of a process. So I reached out to about 15 of the aggregators. We received about 6 LOIs and created a little bit of a bidding process that I think led to a better valuation outcome than maybe otherwise would have been given. So a lot of those reasons all kind of came together.
And once you sold the business, maybe shortly, how was the whole process? And what's next? Did you take some time off, or what was next?
Yeah, so like I mentioned, I kept working at my normal job. I took a minute. I think we bought the house that we're in now, and we moved out of LA. And so there were a few life events that I think slowed us down. My wife, I think the day of closing, the week before, or sorry, it was the week before we signed the LOI, we found out that my wife was pregnant. So a lot of life events kind of merged. And it wasn't until I think that closed in January of 2022, and then we ended up acquiring our first software business for that is now under Evermore in September of 2022. So yeah, I just had a little bit of time to take a step back and figure out what I wanted to do next.
And what was the thought process there, getting into software? Yes, you had a bit of experience before because you had this, what you said, the software, you were able to track the SEO. So before getting into all this, like keeping your job while doing all this, it shows that, first of all, it's possible, like building a company from scratch to exit. That's a unreal story. So maybe risk-wise, to other people who are on this journey of building this holding company or trying to acquire their first company, raising capital, building deal flow, maybe finding the right partner. What are your thoughts when it comes to trying to manage it all while maybe keeping your day job because of the risks?
It's a great question. It's a big question. I get it a lot and have a lot of friends who kind of think the same way. And, I'd say the one reflection that I can share now, a few years removed from it all, is once those kids come, if you choose to go down that path and become a parent, time allocation just fundamentally changes, and pressure around cash flow and just needing to meet daily expenses also fundamentally changes. So if anything, I'm thankful that a lot of that, weekend hours, late night hours, the hustle, if you will, that I spent early in my 20s, I'm grateful for that. And I think it's certainly, possible for people to balance two things. It's not easy, and I wouldn't say that it's for everybody, but yeah, I think if somebody listening here is in their mid 20s, early 20s, it's kind of no better time, in my opinion. And what the day job for a lot of people does do is it provides that cushion or that kind of backstop that allows them to take some risk. I remember the first time we wired, I think it was $12,000 overseas to a person that barely spoke the same language as me, and I had never met and I'd only interacted with over WhatsApp. That's a risky thing, right? That makes a lot of people nervous. And the way I got through that was we opened a bank account. I think we put $20,000 or $25,000 into that bank account. And then I kind of wrote it off in my head. It was kind of like, hey, if I lose this, I lose this. This is some say MBA. I didn't think of it that way, but this is just a write-off, if you will. If something comes of it, great. If not, it's not going to affect our lifestyle. And I think that was pretty powerful. It helped to remove some of that, I don't know, bias you might take with spend, right? It's a different type of spend. It's an investment, and you kind of need to think of it that way.
Okay, now life before Evermore and your first acquisition. What was the thought process? How did you find the deal? Did you do the first one just with yourself, or with your wife, or with your now partner in the business, or how has been the journey?
Yeah. Well, as amazing as First Landings, the whole e-commerce chapter was, my wife and I learned we don't work as well together vocationally as we do as a family unit. So no, my wife was not a co-founder of Evermore. And in fact, the idea for Evermore, the name of it, all of that wasn't a thing when we did our first acquisition. So ended up happening after I had sold the company, is that's when I sort of stumbled into the whole buy then build world. And I'm sure obviously you're very familiar with it. What influenced me the most was, I think it was Walker Deibel's book, Buy Then Build. And coming from an investment banking background, obviously some of the concepts there are similar, just on a micro scale. So I got interested in that, as many people do. I started to explore brokers and the intermediary world. Didn't really know exactly what I was looking for, but a few attributes were important. The first was the diversification, right? That it wasn't a platform dependent business. That was a huge lesson from the Amazon side of the house. Asset light was also a big thing, right? Had just had all this trouble with working capital, wanted something that was asset light. And at the time, I really didn't want investors or debt or any of those kind of things. And I had some capital from the sale. So I was like, let's just go smaller, have full control, be diversified, and see what comes of it. And so, yeah, we stumbled upon this company, Software for Nonprofits. It was actually marketed through Quiet Light, one of the online brokerages, what kind of met all those check boxes. And so that's what led me to looking for a partner. And I also wanted to do a partner for this. I didn't have a direct background in software, and I knew that could be a risk. And B, having just done First Landings with my wife and feeling more kind of solo, there were a lot of, you've experienced it where you want to have someone to exchange ideas with.
So just to understand correctly, the first acquisition you did was already together with your business partner, right?
Yeah, it was. That's right.
Okay.
But it wasn't under the model now of Evermore. Like, we didn't know what would come. It was simply, I remember it well. He was over. We had met. Our background, Scott and I met at UCLA more than 10 years prior. We went different paths out of undergrad, but then we had kind of reconnected. We both now live in San Diego. We both became fathers almost at the exact time, 3 months apart. And so we had kind of reconnected, and it was just serendipitous. I had this opportunity I needed somebody that had a software background, and his was that. He came from product. And so it just, our values, our objectives, our goals, our timelines, it all kind of worked.
A quick pause. This episode is sponsored by Spacebar Studios. If you're growing your business, if you want to acquire companies, if you do add-on acquisitions, if you're raising capital from various investors, you already know this. Capital follows trust, and trust follows attention. That's why I'm a big fan of Spacebar Studios. They build newsletters that compound not just clicks, but relationships, credibility, and pipeline. And one of the best ways to build trust is through newsletter. So what is the track record? For example, they took a compliance newsletter from 0 to 115,000 subscribers in 14 months. They grew a hospitality list to 35,000 engaged operators with 5% plus click-through rates. They also helped SaaS and services brands turn gold lists into 7-figure ARR. So a special offer for you if you run a business which does between 1 to 50 million in revenue and you want to build more trust by using email and newsletter, make sure you go to spacebarstudios.co and book a free call with them. What they do at the moment is the first 6 companies that really book a strategy call this month will get the free custom newsletter built by their team. So go to spacebarstudios.co and book your free call. Now back to the show. What are your thoughts when it comes to importance of that? Because you got this lesson building a business with your wife that, building a business was different than so-called real life. So how was the decision and the conversations with Scott before buying a business? Because it's a big decision.
It's a huge decision. And I will say that I think both of us went in a little naive in a good way as to how important a partnership is and how important it would be. Now I always tell people that decision on who you partner with is everything, especially if you're going to do this kind of holdco model where you want to own multiple assets. And the more assets that you bring into the fold, the more intertwined you become with the partner and the harder it is to disentangle on the other end if things don't go right. But fortunately for us, the key things that I think have worked are that we have the same values. We kind of want the same things from life. We are at the same life stage, and so we're kind of thinking about work and life in a similar way. We have complementary skill sets. So Scott coming from the software world, me more from the finance world. And we were from day one, a big principle for us was we were going to be 50-50 partners in this. So both in terms of how we divided work and in how we brought capital to the table. And I think that I'm happy we did that. And we talk about it all the time, how that really helped lay the foundation for now when we make decisions. It's with complete equity between us and we don't have any kind of a gap there.
And what about it's software for non-profits? What was the size of the business? How was the post-acquisition? And maybe the size of it? And did you need to raise outside capital to get this deal done?
Yeah, so when we acquired it, it was sub $1 million of ARR, small business, highly diversified, even to this day, truly thousands of customers. We did not need to raise outside capital, and that was a big part also of what aligned with Scott and I. We both were able to come to that point and make that acquisition. It was it really was. There was a lot of, I would say, hair on the business in terms of the founder was in, his late 60s. The business was 15, 20 years old. There wasn't a cloud-based solution yet in place. We have since built one. So there's a lot of things that I think maybe would have scared off a traditional buyer. And I think that was an opportunity for us.
And the post-acquisition, when did you decide that, okay, let's go buy another business and let's really build a diversified portfolio of software companies?
That's a good question. And there's really 2 phases to that. The next summer, so that happened in September of 2022. The next summer is when we decided, hey, let's go try this again. Funny enough, though, we actually bought an offline business, a local sign installation company that we still own and is a part of our portfolio. Probably a zag off of your questions list, and we can go into that to the extent it's interesting to you. But we actually went in a completely different direction for the second acquisition. And again, this was before Evermore. And this was very much this notion of portfolio building, cash flow portfolio building. And we wanted to sort of complement the offline experience with something that was more online. The company's a short drive away from both of our homes, and we wanted that experience. So that was the second acquisition. Flash forward another year, and now we're at the end of that year. We're at the end of 2023. That's when the vision for what is now Evermore has really came together. That's where we went out and raised additional capital from investors. We focused on software and specifically now vertical software. The platforms we have today all sort of merged. So depending on how you want to take that response, we did a little bit of a different journey to where we are now.
What are the lessons of this second acquisitions? Because you're in this great position where you can do things like this, or at least you did this. So I think it's a massive lesson, and still you decided that the third acquisition is going to be SaaS and not another like a very traditional business.
Yeah, well, a lot of lessons, man, and we could totally spend a half day together going through them all. But I would say one of the things that we've learned, we've been humbled by with kind of the offline experience is just how critical the operator is. It's important in software, but I think to a large extent, our backgrounds are very helpful there. We can dive in quickly and assess and create direction. And it's just a little bit more aligned to our backgrounds. When we went offline in an industry totally foreign to ours, and with employee types and all the kind of sorts that are just different, I think, frankly, we kind of have come to a determination that in most of those instances, kind of the owner-operator model is probably better. Again, a lot of details there, but that's sort of been the reflection on some of our experience on the offline world. And then in the software side, I think we just sort of, you were green to kind of what it looked like, the market for software companies. We didn't know exactly how to find them, how competitive some of them would be. And I think we just kind of started learning more along those lines of the opportunity. And, I think we had a value prop to sellers that does and did resonate. And that's really why we've moved in that direction.
And you and Scott, what are the strengths and weaknesses? And when did you had to hire like a next person on a Evermore level or Holdco level?
Yeah, we've had so I would say, to answer the first part of that question, Scott's a tremendous leader. He, I would say, is the type of person that when somebody meets him, doesn't matter if they're 65 years old preparing for retirement or 25 years old and starting their career, they like Scott. And he does an amazing job of connecting with people quickly and authentically. And he enjoys that. He really enjoys that people management, the emotional side of running businesses. He's also extremely good around process and thinking from an enablement standpoint, which we have really started to feel importance of. Right, we have a team of 20, 30 people now on the software side, and I think just being in a leadership position is one of the main things, is making other people's lives and jobs easier and finding ways to do that in a kind of systematic way. And Scott's really, really good at that. Those are all things, by the way, that don't come as naturally to me. So I'm learning from him, if you will. I think what I bring is just more of the M&A finance background of kind of what we're trying to do here, which I think, is obviously a good complement to what he brings. Our team, from day one, we had a leader on the technical side. So though Scott is a product, I would consider myself more finance and M&A. Neither of us are engineers by background. And so we do have someone on our leadership team or a couple folks on our leadership team who have been with us early on, who are amazing at that side of the house and have really balanced us out.
What about your thoughts on focus? I mean, now you're focused on SaaS, but you still have this offline business on the portfolio. It must be like a great cash cow for you, and you probably don't need to spend too much time on it. Or how is it in real world?
Yeah, it ebbs and flows. Absolutely. I think we now have a individual that leads that company day to day at the shop with the team, who we have a lot of trust in and who's doing an awesome job. I would say keeping things afloat. He and I do, we meet weekly, we spend time together, and I think, he learns from me, and I'm frankly learning a lot from him as well. So I think it's been very positive overall. But yeah, we've certainly continued to put as much focus as we can on the software side, as that's a little bit more aligned to, the longer term strategy of Evermore.
So when it comes to acquisition number 3, then you had those lessons from this offline business and the software business, but you decided to go like all in with software. So what was the thesis there, and what were the next steps?
Yeah. So, I've mentioned before a lot of the attributes of software that are attractive, generally speaking. And so I think for us, what we've done a bit uniquely, or where we have at least now seen some opportunity, is in obviously the lower end of the market. So we're in that kind of 1 to 4, 1 to 5 million ARR range. Oftentimes, and so far, very focused on either retiring founders or founders who have been, held the company for at least 10 years, haven't taken outside capital, and are specifically serving a very niche end market, right? The TAM is small. You're not necessarily seeing a lot of venture-backed competitors. There wouldn't be a investment case to be made in some of our industries to try to start a new venture-backed. And really, the KPI, and we could talk about this in more depth if it's interesting, but the retention is what we spend a lot of time looking at during diligence, and obviously the value that we're buying into as well. And so many of these companies, we think have a lot of downside protection, both in those two things, and also represent a potential upside if we get it right on kind of a rebuild and a repositioning of the brand over a long horizon.
And what about the structure when buying those businesses? Do you always buy like 100%? And what about the owner post-acquisition?
So far we've bought 100% of all of the companies. The transition periods have been as short as 3 months and as long as still continuing with the business, just in a very specific, usually technology-focused role. Again, so far, a lot of the owners, I would say of the 4, 75%, so 3 of them were retiring. And that was a major, and what was important about that, right, is they were really cared very deeply about who they were selling the business to. And it was a lot more than just a price or a structure conversation. It was what are you going to do with this business? How are you going to continue to serve my customers? How are you going to continue to protect my people? And they really did care a lot about the non-financial aspects of the deal. And I think that's something that, we've focused on from the very first introduction. And that's something that we do to try to stand out. So yeah, and then as it relates to their role long term, again, it really depends on what's important to each founder, and it varies. With some of them, super happy to continue with the business, to just not have to focus on accounting and admin and some of the more management-oriented tasks.
And what about Evermore's model, like when it comes to differing from VC, growth equity, or traditional PE?
Yeah, and to the extent we want to get into it, we're a C Corp. We have a share price. We issued shares, raised capital, used that capital plus debt financing to acquire the companies that we have now. Because of the structure, we can obviously run these companies into perpetuity. We don't have a fixed fund life 5-year horizon. A lot of the way that we set this up as well was to ensure that Scott and I would retain kind of majority ownership, which was a key consideration for us in comparing a private equity or a venture-backed approach. And so, yeah, I think there's trade-offs to all of that, which I'm happy to get into, because I don't think there's one right way to do it. But I think the way that we went about our fundraising process and structuring process is a bit unique, and probably not something that's talked about as often as the other structures are.
As software is asset light, from which moment did you understand that, okay, it's not enough to acquire more businesses and you need to raise outside capital, and then I want to move forward to talk about fundraising?
At what point, it was the question, at what point did we say, hey, let's go raise some capital?
Exactly.
It's a great question. And really what it came down to, and it's a conversation that's kind of ongoing between us, is really that trade-off between I would say speed and dilution. If I really wanted to simplify something, obviously, if you raise more capital, you can go faster and you can deploy that capital faster, but you're diluting the economics to yourself oftentimes long term. And So we're just constantly balancing those two things is kind of how we've thought about it. And so at the time, right back to the end of the second acquisition, we felt like the businesses were good, they were healthy, they were profitable, there was cash flow, but the amount of cash flow that would have been generated needed to then start to get the snowball going to acquire additional assets. It wasn't quite there at that point. And so we opted to move faster, raise capital, take a little dilution, and that has sort of expedited how things have gone. And it's just a constant conversation, even now, as to, well, do we go raise more capital and deploy into more acquisitions, or do we continue focusing operationally and fortifying the investments that we have made? And I'd say so far in 2025, our focus is more on the latter. It's really about fortifying the three companies we bought last year, getting platform strategies in place, and I think perhaps in 26 or 27, we'll reconsider what additional capital might look like.
This conversation today is only possible thanks to Stefan Allman. So he did an intro, and we started talking. Like, Stefan reached out because I tweeted about raising capital from like a smaller ticket from a lot of different people. So I wanna, and you did this. So fundraising with 35 plus individual investors. Talk about the thought process and how did you actually accomplish that?
Yeah, so now we're back in kind of the end of 2023, and we're saying, hey, we've got these couple companies. We think we have something going here. Let's go out and raise some capital. And so I would say that the first step was sort of aligning on the structure that we have now, which was the C Corp and creating a share price, issuing shares, and doing it that way. And so, candidly, I think that was something that I think it would have been more challenging to do that with a single institutional investor. I think just certain governance and things that they would have wanted, we weren't prepared to compromise on, at least not that early in our journey. And we wanted the flexibility longer term, which I'm glad we did. And so then that put us in the camp of thinking more retail. And, we both had our own networks. I did have a bit of a community that I had built online and some of my social presence as well. And so in terms of the how, I think it was a pretty traditional fundraise process at that point. We spoke to, several, probably 100 or so different potential investors, explained the thesis and kind of what made our approach a bit unique. And then, over the course of, it was about a 6-month process end to end, we were able to attract around 35 investors who are now on the cap table.
And what was their feedback when it comes to your portfolio at this stage? I mean, software and then this offline business, and then you say like, okay, we learned the lessons, but we want to move forward with software, but still keep the offline business. Like, it seems like a hot soup.
Yeah, it did, for sure. And I think, and I was reflecting on some of your questions ahead of this, that was a big one, which is that at the end of the day, especially if you're kind of a first-time sponsor or, in our case, capital allocator, they're really betting on you and the person, and they're betting on your track record, and the way that you're able to articulate your thesis and your differentiated view. So, while I think it was helpful to say, hey, we've acquired a couple companies before, one of them looks exactly like what we're going to be looking at going forward, I think that definitely was helpful. At the end of the day, I think it was more us as individuals and our partnership and what we could articulate as, hey, you have one of us, former entrepreneur, had an exit, comes from a background in finance. The other has started a couple small startups on his own, has worked at several venture-backed early stage startups, understands software, understands product. I think that resonated and is why, people kind of got comfortable. And also just the pitch itself, the investment type, right? We were able to explain how, hey, this is, in our view, a very low risk investment because of the multiples that we're buying these at, along with some of the characteristics of the business, that the floor is quite high, especially relative to, your other options, which are probably the S&P 500 or index funds, right? These aren't all highly sophisticated endowment funds that are reviewing PE funds every day. So I think it was the combination of those things that resonated.
Now, when it comes to managing it all? I mean, the investor part, the communication and expectations. What is the system or process there?
I do get that quite a lot. They're like, well, isn't it a lot of admin to manage 35 investors? And I think it really comes down to expectation setting. And so I think we were very upfront early. We even turned away at several investors who we felt like were misaligned on their horizon. We were very clear this is a 7 to 10 year investment and potentially longer, hopefully longer. Hopefully we do a good job to earn your trust and you want us to steward your capital for longer than that. But it's certainly not a 3 to 5 year hold. And so if that's what if that's what you're focused on and you're focused on a 5-year IRR, there's probably different opportunities out there for you. So that was important to begin with. We also, for the first year, we did quarterly updates. 2, 3, 4 pages, just highlighting kind of operational progress. We've now evolved to a semi-annual operational update and then an annual letter that speaks more strategically and higher level. And I think that's a really healthy balance. And frankly, Scott and I have enjoyed the process of drafting those updates and having conversations with investors. I think one of the benefits, right, of having 35 individual shareholders that are all accomplished in their own right and in very different areas of their career, they can really speak into what we're doing and bring unique insights and even unique introductions from their network to what we're doing. So a lot of positives, I think, in that sense.
Now, when it comes to the current portfolio, how has it been so far when it comes to deal flow? What has been working best and what has been maybe, if we can say, like a waste of time?
Yeah. Well, we made a pretty intentional decision around that time of raising capital to kind of double down on the intermediary-led sourcing engine. And what that effectively means is, I think a lot of folks really lean on kind of proprietary deal flow, off-market stuff. And while that's great, and that's certainly a focus for us long-term and something that we're planting seeds in constantly, it's just our experience has been that takes a long time to go through. You have a lot of reasons the deal's not going to go through on a broker-led process, but when it's proprietary, there's even more reasons, and perhaps the biggest of which is convincing a seller to sell and that what the value of their business is worth, right? It's a really hard job to do, and that takes a lot of time and trust building. And so because of that, we focused very quickly on establishing relationships with intermediaries, obviously having a pulse on all of the marketplaces as well. And I think we were pretty picky about what we spent time on. But once we found something that we felt like was a good fit, and in all of the opportunities, there were at least 3, as high as 8 other parties that we know were involved. And we know this from speaking with the sellers now. So I think, again, this kind of goes back to a bit of the approach, which is trying to just stand out as being different. We're not private equity. We're not, growth equity. We're very different. And some of the priorities for us are different. We really cared about what would happen to the company and its people and its customers long term. And that's where we spent all of our time with the seller and all of our talk track.
And who are the other companies who would like to acquire? Are they competitors? Who are you competing with?
So it seems like it really falls into 2 camps most often. The first would be like the independent sponsor world, I'll call it. The solo operator that wants to go out and buy a software company to run. And the second would be a micro PE fund, or sometimes not even a PE fund, not even micro. Occasionally there's the strategic. Realistically, if a strategic is interested and we didn't have an existing business in that vertical, that's not something we really want to compete with. So most of the time it's the independent sponsor or the small PE fund. To the independent sponsor, I think we always have an advantage of saying like, hey, we've done this many times before. You can speak to references and other founders who have trusted us, and we kind of know what we're doing. And then to the micro PE fund, you're not speaking to an associate, you're speaking to the founders of the firm. And so I think that's a differentiator as well.
One of the reasons you've written it out when it comes to raising this capital from so many people, it's people are investing in you and the story. And I believe the same is true with with the companies you can buy and the sellers. So what is your take on this? Because you have brought it out.
Yeah, absolutely. I mean, at the end of the day, right, you're always selling a vision. It doesn't matter if you're raising capital. It doesn't matter if you're acquiring a firm from a founder or you're hiring somebody and asking them to grow a company that you bought. It's all about being able to sell your vision to that person and inspire them and make them feel like, you know, they see what you see and they believe it. So I think that's the angle that we take with all of the stakeholders. And you know, so far it seems to be resonating with sellers. But it depends, right? Because I wouldn't say like our model or who we are, our company is right for every vertical software company, right? The good news is that it seems to be a fraction of them that our approach does resonate with, and that's all you need in a world where, for us, you know, I'd say as we think about the future, 1 to 2 acquisitions a year, that would be great, and I think that would lead to a tremendous outcome.
So what's something VCs and private equity firms get wrong about the businesses you're buying?
Well, I don't know if they get things wrong. I'm not saying we're any smarter than any of them. I'm sure they've thought about all this stuff more than we have, even. But I do think occasionally, what I've seen across searchers and in people in this space is an overemphasis on like the deal concepts and the math and the quantitative elements of making a deal work. And at the end of the day, these are people. And in our case, a lot of times, again, they're the original founders. And so they really do care about who is buying their company and what the strategy of that company, of that person is. And I this was an insight just from me when I was going through my process selling the e-commerce company. I really did care about what happened to it. I wanted to know that the acquirer was well suited to run my company, hopefully grow it, and to continue it. And so, you know, I just think that's really important when you're having that first interaction with a seller. It's not about, hey, I'm going to ask you a bunch of deep questions about your P&L and balance sheet, but I'm going to try to understand who you are, try to understand what motivates you. And then I'm going to focus on your team, your customers, and all of the non-financial things to really feel like I understand the business before I offer too many opinions about what you should be doing.
Have you changed maybe just even a little bit of your strategy of especially the software acquisitions you've done? Like what type of companies you're looking for? Because I'm just trying to understand like what exactly are you looking for now, today, and has it changed since you started?
100%. It has definitely changed, but I would say it's as tight now as it's been. And so I can explain kind of an ideal scenario would be, well, something that's already in our portfolio. So if it's in one of the verticals we already are in, you know, we are very actively looking at other kind of, you call them add-ons, but other companies that are serving the same end market. But outside of that, you know, we're looking for things that are serving a niche end market, as I mentioned, a small TAM. We are looking for things that are highly retentive and so very difficult to replace. And we're looking for things that we believe we can come in day one and create some kind of operational value. A good example of that is one of our recent acquisitions was an ERP system. And they hadn't yet embedded finance into their product to monetize payments. And that's something that we've been working on now for a better part of 9 months. And we knew kind of going in that, yeah, maybe we didn't know the industry dynamics and we weren't certainly experts on exactly how the workflow of our customers was, but we understood embedded finance and understood the opportunity and could get a bit of conviction on the size of it before closing, and that gave us confidence.
When it comes to the size of the portfolio companies, have you been maybe seeing that, okay, you're doing pretty well, keeping the size of the business the same when it comes to revenue, or are you trying to look for bigger businesses? How has it been?
So far, we really feel pretty comfortable at kind of the size I mentioned before, that 1 to 5, 1 to 3 range, and you know, frankly, would like to stay in that group. because I think going back to some of the questions about, trade-offs, right? We could go buy a $5 million ARR business at a 6x multiple and need to go out and raise that kind of equity to do that. But it's going to come with a difference in the economics back to us as a holding company. And it quickly, as you move up market in that sense, it quickly moves more to the traditional, PE type 220 model. And so there's a reason that, we believe that lower end of the market, the 1 to 3, is underserved because you're not incented as a private equity firm most often to be spending time there. You got to be a really small firm to make that work. And even then, it probably is not going to math at the end of the day. So for us, we still think there's an open opportunity there.
Now, when it comes to your experience, previous experience, investment banking, M&A, how has, as the portfolio has been growing, how has the debt and equity ratio, has it changed? Have you been more aggressive with debt? How's that today?
Yeah, I think, one of the fun attributes, so to speak, of this kind of a model is obviously if you see some organic growth across the portfolio that can open up capacity, if you will, for additional debt raising. And while a lot of what we've done has kind of been deal by deal specific on the debt side, it's certainly allowed us to continue to kind of push the envelope on the type of loan to value that we'll be looking for each additional acquisition. So, yeah.
Now, how large is the portfolio today? How many companies have you acquired?
On the software side is 4 companies. We kind of think of them as like 3 platforms. And we're on pace to be looking at somewhere in the neighborhood of about 5 million of ARR.
My question, you see a lot of deals, a lot of those super niche businesses, markets, industries. Have you thought of taking this one specific platform and like really going all in on this? And obviously this means it's not that diversified anymore, but have you thought about this?
Yeah, it's something we do talk a lot about. And I think it's something we're very open to. And that's part of when we talk about the initial vision of Evermore and why it was important to us to retain governance and ownership in the way that we did. It was because I believe it allows for more flexibility as we look at these types of questions in the future. And so absolutely, right, if we see one of these platforms and we think that the opportunity perhaps even to accelerate growth in a more dramatic way makes sense and should be capitalized accordingly for that specific platform, we do have flexibility to do things like that. I would say as it stands right now, our focus has been on forming those platforms, making sure that we feel really good about the quality of the businesses that we're buying and we're downside protected. And frankly, all of the examples, there's an element of kind of rebuilding the technology stack and repositioning the brand. And I would say that is what we are, day to day, that's where we spend a lot of our time. So on the other side of that, I do think there's some interesting strategic choices we'll have to make, but we're not quite there yet.
So back in 2023, July 2nd, you posted that you have this thesis you're developing, and it's about like 7 trillion of profitable small businesses will change hands in the next 25 years. And you talk about you can still buy those assets for 3 to 5 their annual profit. And you say that it's almost 3 years ago, almost 2.5 years ago. And I'm not the first to identify this opportunity, but some famous folks on Twitter like Brent Beshore, Andrew Wilkinson, Seva, Vivier, they're way ahead of you. And you've said in here that I think we're in the second inning of a 9-inning game. There will be many winners. A lot has changed over the past few years, different reasons, obviously. Lots of tailwinds, lots of podcasts about people like yourself who are buying businesses, building those portfolios. So long story, but where are we today, in your opinion, opportunity-wise, competition-wise, and what are you maybe worried and excited at the same time when it comes to the next 5?
It's a good question. I think that we're still early. I think demographically, I still think there's quite a few of those whatever you want to call them, baby boomers or retirees that are thinking through succession planning over the next 5 to 10 years. Whether we're in the second, third, fourth, or fifth inning, I don't know. But I do think we're still early. I think there's still a tremendous opportunity if you want to talk in the offline world, which isn't where we, spend a lot of time today, but I'm still in the ecosystem and connected. I still think there's a lot of opportunity for hands-on owner operators who want to acquire a good small business with a history behind it and run it themselves and create wealth for their family and the lifestyle that they want. I still think that's a great opportunity for a lot of people out there. Obviously, we think about more of kind of the vertical software side. And I think what our strategy really is a bit different than that, right? And we're at this point more in we're not the owner operator type model any longer in how we think about it. So I think that quote or that tweet from years ago was more aligned to the owner operator. I'm going to go buy a small business and do it myself kind of thing. And I really do think there's still a lot of opportunity left there.
So your portfolio today, 4 software companies and this one offline business, what are you struggling with the most at this stage? Like once we finish this podcast, it's a early morning for you. Like what are you struggling with? What are you working on? What is maybe some of the headaches you maybe reaching out to people who are a few years ahead of you asking questions? So yeah.
Yeah, I mean, it's funny, but I'm sure a lot of people, running companies like this would resonate. I think it's all people related. Trying to simplify it. I think we spend a lot of time thinking about, do we have the right people in the right seats working on the right things? And there's a lot that comes with management of staff and management of teams. And so right now our focus is on, and it kind of goes back to one of our themes for this year back in our annual letter, was really fortifying the investments that we made last year. And so as we think about what that means, it really means feeling like we've transitioned these companies well, we have the right people on our staff, and that, anytime you go through an acquisition, there's that takes time to backfill people and to train people and all the sorts. So I'd say really on the management side is what we spend a lot of time on right now.
You catch this trend by obviously working hard. I mean, you were very active on Twitter and social media, but from one moment you're not active anymore. What changed?
People.
What do you mean?
Needing to manage people. No, I just mean, we went from, I think my opinion of content and engaging on those channels is that it can be very productive and very beneficial, but it can also be very distracting. And so it depends on where you're at a bit in your life and in your career journey. And I think when I got onto Twitter in 22 or 23, I kind of was in that bridge period between having exited my company and not sure what I was going to do next. Felt like while I was young, I had some things to share for folks that were 5 to 10 years younger than me. Kind of what's it like to build a side hustle that actually works out and keep your day job. And so, and had done some real estate investing as well. Thought there was some things I could share there. And so it started from a very truly, let's just share what I've learned mentality. I think my initial inspiration for all of that was actually Justin Welsh way back when. And I think that was a lot of what he kind of talked about, right? Just write to the person 5 years younger to you. And that resonated. I didn't ever really think of it, at points I saw glimmers where like, hey, this could be like the foundation of a strategy, right? The Nick Uber, this is your distribution and all that. And I just learned quickly that's really not for me. You have to be a person who loves writing and loves that whole side of content, I think, to build the foundation of your business around that. And that wasn't really it for me. I found that writing and distilling my thoughts was positive and accretive to my business. But at the end of the day, we're kind of in a point right now where we're just executing. We're doing a lot of things. We're launching products. We're looking at companies. We're meeting potential people. And so it's really how much time you have in the day equation. And so I had to sort of reallocate my priorities.
Can we say that you got what you looked for and now you're just, as you said, executing, doing the work?
I think so. I think I'll be back in a sense of sharing content again. And I always think I resonated with, hey, I was able to build a company, the first one. I was able to sell that company, and it was objectively successful. I'd like to share this now with people in case they can benefit or inspire them. And so right now, I feel like I'm back into the first inning, right? We have this new concept with Evermore. Yes, we're a year and a half into it, but it's still relatively new, not on the horizon of what we're trying to do. I really want to spend, every second I can, being as successful with that as I possibly can be. And so, certainly at different points in this journey, if it feels like, okay, we're at a place now where, there's things to share and there's insights that I want to get out there more consistently, then that might change and my time allocation to content might increase again. But for right now and for the next, the rest of this year kind of a thing, we've just sort of decided that my time is best spent in different lanes.
Yes, I think one moment you should start doing it again because you have a great story, you have a lot of great thoughts, and most importantly, lots of experience now. So I believe lots of people would find it extremely helpful.
I appreciate that. Yeah, I really do. I struggle with it. I really enjoyed waking up, thinking about what I was going to say and trying to, again, capture thoughts. And there was good parts of that. But as you probably know, the tools can be quite distracting. You can, and one comment from some random account can really throw your day around. And so I think that's something I could personally work on probably.
You should just post and ghost, or how they say.
Probably should.
Okay, Danny, lots of fun. Really like your story. You have so much experience, and I'm what I'm oftentimes most excited about in most of those podcasts is I can do it again with this person 1 year or 18 months later, and they will probably, many of them, buy many more businesses and have many more lessons. So I would like to do the same with you, and you can be sure I'll follow up. But thanks a lot for doing this today.
I appreciate it, Mick. And you did an amazing job on your prep work. I was so impressed by all that went into it, and appreciate your patience with my technology lapses here and the lack of a camera. But I had a really great time on it, and yeah, would happy to do it again in the future.